Yeah, so here we can see in 2 periods the S&P beat it, and 3 periods the Russell beat it. So it shows the larger picture of what the super investor aim is to beat the indexes consistently over the long term, and they're very well doing that. This was really fun, the efficient frontier. So as we can see, this is showing that the super investors were beating the modern portfolio theory. So I took the 20-year averages from the S&P 500 and the 20-year average from the Barclays Aggregate Bonds Fund, and so with that, you take the expected returns given the weighting, and then the portfolio standard deviation given the weighting. So the line you end up with is the slightly curved line, and then the capital allocation line is what the optimal will be, and so that's taken by finding the optimal weight of 1, and then doing 1 minus that weight, and then finding the expected returns and the portfolio standard deviation of that. And so the equation for that was, let's see, is 0.427 plus the risk-free rate, which is 0.082, and that was taken from the 10-year average 20-year for 20 years of the 10-year Treasury bond. And so this very clearly shows that the super investor index is beating this capital allocation line and beating the expected risk given, or the expected return given the risk they're taking. And so we can see that here. Given the capital allocation line, with the risk they're taking of 17%, their expected return should be 12.1 given perfect diversification and asset allocation. But instead they had returns of 14.2%, showing they clearly were beating the indexes with, like on their own terms, they're beating them on the terms of risk to return, showing a higher Sharpe ratio than the line had. So again, they're showing they beat both of these theories by showing consistent abnormal returns over the market and given the risk they're taking. So they beat the modern portfolio theory with by beating the capital allocation line and getting a return that was over 2% higher than the expected return given the risk they're taking. When they're able to do this, not through diversification, but through picking stocks that were more highly valued than the stock prices were showing. So they consistently can beat it for 20 years. And so when considering this, I would be very comfortable investing in this because, the results show they're very easily beating the indexes and they're doing it consistently. So given my age, this would be the top choice for investing because if you have the opportunity to have high returns with less risk, you take it. It's very obvious if you are able to do it, then you should do it. You should take higher return with less risk. Given my mom or someone around her age, it would also be, it would be a smart choice given the results of the method, but there would be some caution onto whether they will reach retirement or they will need their money back in less than 10 years and might be in those 2 periods or the 4 periods against the Russell where they are getting returns that are lower than the indexes. So the time horizon would be key here because super investors are looking long term and have a longer time horizon. It may not be a perfect fit for someone who is nearing retirement or needs quick access to their capital because they may not be able to let the securities realize their full value. So the secret to this is consistent returns, not blowing it out of the water, while in some periods they did, but consistently beating the market. In downturns they beat it, and upturns they beat it. and so the compounding returns of this starts adding up and makes it really beat the market over the long term. Another secret is, and probably the most amazing thing they do, is a paradox between lowering the risk and raising the return. So by having a larger margin of safety, finding a company that's at a deep discount, they lower their risk because the asset will be lower priced, while raising the opportunity for return when the security fully realizes its value. And that's something that's, it's very unheard of in the market. The market is you take risk and you get return, a higher risk, higher return. But the super investors flip that around. And interesting, they focus on particular value stocks, some of them choosing only a few and putting their full confidence in that, putting most of their capital in that, rather than knowing 100 stocks, barely knowing each of them. They're able to do what they're very confident in, and not have to worry about diversification, asset allocation, even though some of them do that. That's not what they need to focus on. And lastly, the big secret for them is that they're patient. They know their method, and they're willing to wait for the securities to realize their values. Again, that's why the 10-year rolling return is so evident, is because they're willing to keep it in even in downturns, and they know what they value the company at, and they're willing to wait for that. So it takes a disciplined person, which is, again, why value investing is not the most popular method, because people get scared and they want to take their money out before their assets are able to reach their full value.
Yeah. Perfect example of that is just your cumulative return slide, where you're barely even beating the market, or you're barely even beating the S&P and the Wilshire for the first 10 years. So you can see a lot of people getting really frustrated by that. But it's just exponential growth after that. That's probably my favorite slide on this one.
Yeah. I think that was the biggest thing I realized is, every once in a while I look at Berkshire and look at their stocks, and while they're performing well, they are just beating the market, but that's all they need to do. They need to consistently just beat the market. It really shows up over the cumulative returns.
Yeah, it's just the power of compounding at its finest.
It is.
Well, I'm sorry. Do you have any more slides?
I
believe it's just a reference slide after that. Is that correct?
Yeah, that's right.
Oops. Yeah. Okay. Very good job.
Thank you.
You hit most of my questions. That was really good. For the 10-year rolling period returns, I believe you answered that one actually. The benefits of using rolling period returns. That is What are the benefits of using the rolling period returns?
Yeah, the benefit is because looking at a single year, it may give us a skewed or incorrect image of how the fund is actually doing. So given maybe in 2000, or it may look like the SI or the super investor index is not doing that well, but given the rolling return, it averages out the bad years and also the good years. It gives a better picture, a larger picture of what the index is actually doing.
Yeah, very good. You see different years like 2008 or 2000 to 2002. It's just on paper it looks horrible. When you do the actual rolling period returns, you can see how it's lessened, or it looks better than just the negative 38 something %.
And I think that should be true of everything. Is a company can harp that they returned 20% that year, but last year and the year before that they lost 20%, and they can market that 20% this year, but that's not necessarily the case for the company.
Very good. Using the volatility, how do you feel as volatility as a measure of risk?
Yeah, that's been one of the biggest questions I've had during this. I believe the super investors wouldn't consider that risk. While beating the indexes on that measurement, I think risk for a super investor would be margin of safety. So if they have low margin of safety, that would be high risk for them. So risk would be picking the right stock and being confident in it. Whereas, yeah, risk for the market is how volatile it is, how far it is going to stray from the average. When I don't think that's always the case, because as super investors say, it's not about if your stock is going down. It's when you sell it, is it going to be up? And if you can wait through it, I guess it doesn't. If you're confident it's going to reach its value, I guess it doesn't fully matter which path it takes, how much variability it has. Even though, again, the super investors did have lower variability. It's more of confidence that when you want to take it out, or when you are going to sell it, that it is up, that the security has reached a higher value.
Wow, that was one of the better answers I've heard during these. That was good. That was really good.
Well, thank you.
You get other answers like, yeah, risk is volatility. It's like, no, well, I mean, you got to look at it. It's also, that's just from, historic returns. You can't always use historic returns to, predict the future. That's not how it works. I mean, in some cases, I guess you can, but overall, it's not really ideal.
Yeah, I know. It's interesting that is our measurement of risk now, is fully based on past performance.
Yeah, as opposed to what, though,
What the stock is.
Yeah.
Or what the security is. Like, that doesn't even matter anymore. Yeah, that's funny.
On your efficiency frontier, you had a risk-free rate of, what was the risk-free rate on that again? Looks like 4.82%.
Yeah, it was right around there.
Okay, and how did you find the risk-free rate?
So it's the average, 20-year average of the 10-year Treasury bill.
Okay, that's good. That's really good. Yeah, I've seen ones that just use the 10-year currently, which is it's just so
which
awesome.
Is 2 point
Yeah, it's like 1.15 or 2. Yeah, something extremely low. So that was good.
Yeah.
You did the right thing there by doing the average of those, because it's over a 20-year period too.
Yeah, well, if you're doing everything at 20 years, then that has to be at 20 years, or else we'd have a very steep capital allocation line.
Yeah, seriously. Okay, well, great job. Do you have any questions at all or anything? Because I'm pretty much out of those. Yeah.
So I'm guessing you guys focus on value investing. I'm guessing that's why it's such focus. So what ways do you think value investing has changed? What are the ways it's I mean, looking back at Benjamin Graham's initial thoughts on it, obviously the market has changed so much since then. In what ways what ways is it most different from then, and how to approach valuation in a market that is going towards intangibles in a lot of ways, especially banks. Yeah.
Well, I mean, you got to find out how to put a value to all those things. Instead of, back in his days, it was all about tangibility. But now you're getting to a point now where, there's copyrights, there's trademarks and things of that nature, to where it's so much